You ever look around and wonder, what it actually takes to build all this stuff? I mean, the steel in your car, the copper wires hidden in your walls, the aluminum casing on the laptop you might be using right now. It all has to come out of the dirt somewhere, right? Well, welcome to the EDGAR Brief. This is your explainer of SEC filings for the everyday investor, where we take the incredibly dense, jargon-filled language of Wall Street and translate it into plain English. Today, we're cracking open the latest May 2026 Form 6K from a company that literally moves mountains for a living. I'm talking about Rio Tinto. Oh, and just a quick note right up front. We are completely independent, not affiliated with the SEC, and we are definitely not financial advisors. We do use AI to help summarize things, so, errors can happen. Always verify on sec.gov before making any money decisions. Okay, let's jump right in. So, look at this absolutely staggering number, $9.9 billion. Now, if you were glancing at a normal corporate filing, you'd probably assume, oh, that's their revenue, or maybe, hey, that's a really healthy annual profit. But no way. For Rio Tinto, $9.9 billion is just the amount they paid out in taxes and royalties to governments in the year 2025. Yeah, just taxes. It's an incredible figure, right? It instantly gives you a sense of the sheer, massive, sprawling scale of this global operation. To make sense of a beast this large, we need a roadmap. So here's our agenda for today. 1. What is Rio Tinto? 2. The production scorecard. 3. Checking the moat. 4. Risks and red flags. And 5. The bottom line. All right, kicking things off with Section 1. What is Rio Tinto? And more specifically, how exactly are they like a vending machine? Seriously, think of Rio Tinto as this giant, planetary vending machine. Their whole business model is actually remarkably straightforward, even if pulling it off is insanely complex. Basically, the global economy inserts cash, we're talking billions of dollars in capital, into this machine. And in return, Rio Tinto takes that cash, buys these massively huge trucks and machinery, digs enormous holes in the ground all over the world, and dispenses the raw ingredients we need to build modern society. They give us iron ore for steel, copper for electrification, aluminum for, well, pretty much everything. Then they sell these raw commodities to global manufacturers and construction firms. So basically, Rio Tinto is just a giant toll booth on the road to global infrastructure. Now, you might be wondering, what exactly kind of document are we looking at today? We're analyzing a Form 6K. For the uninitiated, this is basically the official form that foreign companies use to update the US SEC between their big annual filings. But here's the catch with this specific filing. It doesn't give us a traditional profit and loss statement. You won't find any revenue or free cash flow numbers here. Instead, this 6K acts purely as a scorecard of what they physically pulled out of the ground in the first quarter of 2026, plus a detailed receipt of those 2025 tax payments we just talked about. But look, for a mining company, production volume is the ultimate precursor to cash. If you're not moving dirt, you are not making money. Which brings us perfectly to Section 2, the production scorecard, where we look at those Q1 2026 volumes. So, the big question, are more potential dollars walking in the door? Well, according to this first quarter of 2026 data, the answer is a definitive yes. Check this out. Copper production is up 9% year over year. And then, over in Western Australia, their Pilbara iron ore operations, which, by the way, is the absolute beating heart of their entire business, saw production jump 13%. Actually, this was their second highest first quarter Pilbara production since all the way back in 2018. And remember the golden rule here. More rocks coming out of the ground means more inventory to sell, which ultimately translates to higher potential cash flow down the line. Now, in the filing, management boasts about a 9% year-over-year growth in something called QEQ. That's heavy mining jargon that stands for copper equivalent. Let me translate that into plain English for you. It's basically just a math trick to add apples and oranges. See, when a company mines iron, aluminum, and silver all at the same time, they can't just add the weights together because the prices of those metals are totally different. So what do? They pretend all the metals are copper, adjust for the price differences, and boom, calculate one single total volume metric. So when they tell us copper equivalent grew by 9%, it just means the total value-weighted output of their entire planetary vending machine grew by nearly a tenth in just one single year. Pretty impressive. Since we don't have those revenue figures in this 6K, looking at their 2025 government tax payments is actually the best way to trace where this massive vending machine is physically located. And wow, Australia is the undeniable cash cow.
Rio Tinto paid roughly $5.4 billion in taxes and royalties just in Australia alone, heavily driven by those Pilbara iron ore mines. But then look down here at Mongolia, coming in at about $373 million. That's being driven by their massive Oyu Tolgoi copper mine, which is currently ramping up. Meanwhile, older, more established regions like Canada sit at around $65 million. These tax payments map out their sprawling global footprint perfectly.
All right, moving right along to Section 3, checking the moat, where we look at their durable advantages. Listen to these words directly from Rio Tinto's chief executive, Simon Trott. He says, the unmatchable mix and scale of our portfolio has ensured growth and supply chain resilience. Now, in the investing world, this speaks right to the heart of what we call durable advantages. I mean, think about it. You and I can't just scrape together some venture capital, spot a brand new mountain of high-grade iron ore out of thin air, and attach a fully built private railway and port system to it. No way. The barriers to entry here are just astronomical. Their moat is pure, unadulterated scale and geographic diversification. But it's not all sunshine and rainbows, which brings us to Section 4, risks and red flags. Let's talk about some real-world headwinds. Because if you read between the lines of this filing, there are some serious real-world risks hidden in the text. Scale definitely does not mean invincibility. The filing highlights 3 major areas of concern. First, and absolutely most importantly, is the human cost. Management actually opened their remarks by addressing 2 tragic employee fatalities this year, one at their Simandou project in Guinea and another at the Kennecott mine in the U.S. It's a really stark reminder that mining remains a highly dangerous physical operation, and safety lapses are a devastating, ever-present risk. Second, they are entirely at the mercy of Mother Nature. Extreme weather hit them really hard this quarter. And third, there's this fascinating geopolitical bottleneck. Their massive new Simandou iron ore project in Africa relies heavily on Chinese ports. They literally have to ship the raw rock to China to do the final tertiary crushing before it can be collected by the customer. That is a huge supply chain reliance on a single foreign nation. So the crucial so what here is how these risks actually impact the business. Look at the comparison between production and sales for their Pilbara operations. They produced 78.8 million tons of iron ore in the quarter, but they only sold 72.4 million tons. So where did the rest of it go? Well, cyclones Mitchell and Neril absolutely hammered Western Australia in February and March, and those storms ended up trapping approximately 8 million tons of ore at the port. And remember, you can dig up all the valuable rock in the world, but if you literally can't put it on a boat, you do not get paid. Those cyclones directly bottlenecked their real cash earnings for the entire quarter. Which brings us to our final stop, Section 5, the bottom line and our key takeaways. To sum it all up, Rio Tinto is this massive, highly moated commodity vending machine that's currently enjoying some really strong production growth, especially in copper and iron ore. But they are permanently bound by the unpredictable limits of weather, geopolitics, and operational safety. So going into the next filing, here are the 3 big things you need to track. Number 1. Did they actually recover and sell those 8 million tons of cyclone-delayed iron ore shipments? Number 2, keep a close eye on that Simandou mine. They expect permanent crushing facilities to ramp up in the second half of 2026, which is going to be a huge milestone. And number 3, watch closely for commentary on operational safety improvements following the tragic events of this quarter. And that is your EDGAR brief on Rio Tinto. Remember, guys, this was an explainer and a translation, absolutely not a financial recommendation. Please go read the original filing on sec.gov if anything we talked about today piqued your interest. Thanks so much for joining us here at the EDGAR Brief. But it really leaves you wondering, doesn't it? When a multi-billion-dollar company's biggest threats are global superpowers and Mother Nature, is any moat truly unbreachable? See you in the next filing.